What's going on, y'all? Welcome to another episode of Spill the Beans. I am Tim Bratz. Today I'm sitting down with my buddy Daniil Kleyman. He is a real estate investor and developer who does some awesome stuff out of Virginia. And so he's in the Richmond market and does a lot of like spec builds and new development, new construction, multifamily type stuff. And just a smart guy, very technically minded, and at the same time has the art of being able to communicate very effectively. Very intelligent guy. So Daniil and I, actually his podcast was one of the first ones I've ever been on. So I've known him for several years, met up with him for the first time last year, and just has become a great friend. So I know you guys are going to get a ton of value out of this. Let's dive into Spill the Beans with Daniil Kleyman. Welcome to another episode of Spill the Beans. Today, I got my buddy Daniil Kleyman here. Hey, this guy's an absolute stud, has a lot of good stuff going on, and we're going to dive right in. Tell me what's going on right now. What are you focusing your time on? Rehab Valuator, the real estate side of things?
Software,
education?
real estate, both. Yeah.
Let's talk.
Kind of both.
Let's hit on all of them. Tell me about your real estate, what you got going on, and then I want to know about the software side of things. I'm looking at some stuff myself on more the multifamily side and management side, maybe some lead gen stuff, and then the info stuff that you got going on, dude.
So, real estate side is what I'm most excited about. I mean, I'm primarily developing mixed use and ground up multifamily.
Yep.
So it's a lot of work, but it's fun.
Where are you at? New Jersey?
Richmond.
Virginia?
Not in Jersey. No.
Yeah.
Nothing wrong with Jersey, but I don't think I could do business in Jersey. I'm in Richmond, Virginia.
Ah, dude.
You know,
I knew it was somewhere up mid-Atlantic area.
Mid-tier market, not a ton of competition.
It's a great market, yeah.
People migrating down there right now. We're seeing a lot of people actually from up north, Jersey, New York, Boston. People are moving to, you know, they don't make it all the way down to Florida. They're coming to us.
Yeah.
So we've seen a good amount of net migration into our market.
Right.
So our rents have risen. Rental demand is
You're focused on
fire.
multifamily, right?
Multifamily, and you know, when I say mixed use, I usually mean like less than 20% of the building is commercial. Mm-hmm. So we do primarily
like ground floor retail with
ground
apartments
floor
above it.
retail. Yeah, so we primarily do infill development, right? I'm not going out and developing raw land somewhere and doing large subdivisions or developments. We're doing infill projects on usually in urban lots. Mm-hmm. So I like doing multifamily because it's easy, but in certain locations it makes sense to add commercial component to it.
Oh, for sure.
And it amenitizes the building better and amenitizes the neighborhood. Just improves the entire project, basically.
Has the whole COVID thing with, you know, retail and a lot of retail going off, you know, and on the more e-commerce side of things, has that affected you at all? And or you ever have a ground floor like office space that has been affected, or
no?
Not really seeing that in the areas that you're in.
It hit us for a little bit because we had a couple of restaurant tenants, mm-hmm. and they shut down for, you know, back COVID hit 2020, 21, winter of 2021. Like one of our restaurants shut down completely for 6 months, mm-hmm. right? It's before vaccines came out. I mean, they just didn't want to be open at all. So I mean, so they weren't open for business at all for a period of like 6 or 7 months. But most of our commercial spaces, most of our tenants are, well, actually, they all survived. We cut rent for one of them for the restaurant voluntarily. So that was really the only rent we didn't collect through COVID. We had a yoga studio that opened literally for the first time in March 2020, right? 2020 or 21?
Yeah, 2020.
2020. Right when lockdown started happening, she was a first-time business owner, opened the yoga studio on March 1st. As lockdown started happening, she somehow survived and is doing well and kept paying us rent.
No way. It's amazing.
First time entrepreneur, like, talk about resiliency.
Yeah.
It's amazing. So I mean, I always tell people if you're doing commercial leasing, the type of business that's going in there is important, but you want to pay very close attention to like the jockey, not the horse.
Love it.
They need to be resilient. She slugged through the entire time. She built yoga pods out of plastic shower curtains. and people came in there and did yoga inside these plastic bubbles.
No way.
It was. I mean, it looks hilarious.
Dude, that's epic though.
But it brought people
talk
in.
about resourcefulness, right?
It brought people in. It was amazing. Yeah.
That's awesome. So, all right. So tell me, you're in a unique position, right? It seems like something like that wouldn't have a lot of competition, where you can kind of go and cherry pick certain lots all over the place, grab it because one, development is one, land doesn't have a huge driver as opposed to something that's already built, right? As much competition, I would say. And then the second thing is you got to be a badass at construction in order to develop that kind of stuff. The supply chain's all messed up, the labor force is all messed up, and contractors finding good tradesmen, right? Prices are going up, or they're hard to find, or they're too busy, or anything like that. So I got to believe like the upside for what you're doing is great, right? But there's a lot of work that goes into it. So are you having a tough time finding these infill projects?
I'm still finding opportunities. I've also been land banking for a while. You know, I came out of the same world that you came out of, single family houses, right? So when I was back after the recession, when I was renovating single family houses, renting them out, when I was flipping, I started slowly land banking and buying land.
Yeah.
So some of the stuff I'm developing, I've owned lots for 5 or 6 years. But there's a lot of land I'm developing now that I've purchased in the last 3 years when the market has, you know, you couldn't give land away back during the recession.
Oh, dude. Yeah.
Around 2016, 2017, that
Nobody wants-
changed.
yep.
Everybody wants land now. But I'm still finding opportunities. You have to be more creative about how you identify those opportunities. Like, a lot of the deals I'm doing now, we're repositioning properties, meaning like 2 days ago I closed a medical office building, vacant medical office building on a half-acre lot. It's been vacant for a year. I'm chopping it up into 12 lots, and I'm going to build 12 single-family for-sale houses there, and then 4 duplexes. So I'll have 8 rental units.
So you're ripping the whole building down.
And it's a nice building. It's a brick building. It was built 40 years ago, but it's not serving its best and highest use.
Yeah.
So I'm ripping it down. I'm going through a special use permit, which is a type of rezoning in my market, and we're chopping it up into 12 lots. And instantly, the value of that land is going to go up by 30% once that's approved, which should be in a couple of weeks. And then I'm going to build a little mixed-use development on it. So deals are out there, but you can't easily cherry pick them off the market anymore.
You got to be a little bit more creative, right? You got to figure out how do you add value to it.
You've got to be able to look at real estate through a different lens, right? You can't just see things for what they are. You have to be able to see things for what they could be. And for that, you need to understand value, right? And you need to understand local zoning and how you can, I hesitate to use the term manipulate local zoning, but how you can change it, how you can extract more value out of that land.
Let's talk about that. How do you?
It depends on your county. If you're in a seriously NIMBY type neighborhood, you can't. Now, if you're in a neighborhood that's all single family houses and every neighbor around you is like, we will not allow anything else to be done here, you can.
That's pretty standard, right? That you find that? Like nobody,
it
like as soon as somebody raises their hand and says, "Hey, I want to put a commercial piece of property here in a residential neighborhood," I don't know. Every time I've ever seen that, it's everybody throws and they balk, right?
It largely depends on what kind of area you are, how affluent it is. Where I develop, it's an urban neighborhood. There's multiple zoning types within the neighborhood. It's already a mixed-use neighborhood, right? And people that live there generally want walkability. They want commercial, and it's not just single-family houses. So I've taken single-family parcels and I've just rezoned them and built duplexes there. I've taken single-family larger parcels and I've rezoned them and I've built mixed-use projects there. So you've got to take the temperature of the neighbors, council people, local planning department, right? Whatever county, city you're in, they're typically going to have kind of a master plan for what they want to see developed and how they want neighborhoods developed. So it helps if you're not going against the grain.
Yeah.
It helps if, you know, their master plan calls for residential and you want to put like a car factory there. Well, that's probably not going to fly.
Right.
Right? So we typically try to swim, you know, with the stream.
With the current.
With the current.
Yep.
Right, when it comes to rezoning, because otherwise you're going to get bogged down in the battle that you're going to fight for years, and it's going to cost a lot of money.
Yeah, man.
So.
No, that's good. That's good. So, is there a certain asset class that you really love, or you just like anything if it makes sense and it can cash flow? Are you building it?
No. I mean, we specialize in Class A multifamily for the most part.
Yeah.
You know, everything I built is high-end, high-quality finishes. We rent at the top segment of the market. I don't do Class B, I don't do Class C.
And you stick to your exit strategy is to refinance and hold those, right?
Correct. Correct. Now I have a
Do you ever sell?
I have a home building division, and we build houses to sell, usually single-family houses. It's a small
Spec
part.
builds also?
Spec builds. It's a small part of my business. I mean, we may build 10 to 20 houses a year. I mean, this year we'll probably do 25. It's not a big part of my business because I don't want that exposure to the market.
Sure.
If the resale market drops out, I don't want to be stuck with 25, 30, 40 houses.
Yeah.
Rental market is more resilient, right? Rates start climbing, people stop buying houses, they'll still rent. So if I have 200 apartments in the pipeline, as long as I've got my costs locked in, my financing locked in, I feel safe bringing that to the market. I'll rent them. So, but my focus is on Class A product.
Love it.
Because we manage everything in-house. I have an in-house property management company, full-time employees, and we've managed Class C product before.
It's tough, dude.
I'm not interested.
Tough.
I'm just not interested. Even if it cash flows better.
Well, on paper, it always cash flows better.
Sure.
Right? And in reality, the amount of turnover and the amount of headache and the amount of just brain damage
Yeah.
that comes with Class C, people, they discount it when it comes to looking at a deal on paper, and they always go towards Class C.
It's miserable.
If you've been in this business long enough and you've owned and managed, especially if you have in-house management, you understand what it's like. It is way better, and you will make better returns long term. Class B plus to A.
Yeah,
You know?
absolutely. And you'll retain people better in your property management business because their life is easier.
Oh, yeah, that's a great point.
You know, I hesitate to say they deal with better quality people. I think that would be offensive, right? They're dealing with people that have less financial difficulties.
Yeah.
They're dealing with better quality renters in terms of paying. I mean, we have no vacancy. We are 100% collected on our rents by the 5th of the month. I haven't filed an eviction in 10 years.
Really?
I have not evicted a single person in 10 years.
Wow.
I haven't had to file a pay or quit notice in years.
Wow.
All of our rent gets collected.
And
Even
what's
through
the average
COVID.
rental rate? How much per month? Are you like 2,000?
No, our ones right now rent for probably between 11 and 1,300. Our twos rent between 15 and 1,700.
Yeah. So to me, it's not.
But
That's
for
not
Richmond,
like a luxury
for Richmond, that's
rent.
like,
Is it?
you know, that's up there.
Yeah.
Yeah. You'll find higher rents in larger amenitized apartment complexes.
Yep.
Because they got a nice swimming pool. And I'm getting ready to build one of those, and we're going to have a nice swimming pool and a gym and a co-working lounge, right? So they're able to charge a little more rent. But we're right up there.
Yeah.
But
yeah.
that in turn attracts.
Well, I think that's I love that sweet spot as long as you can cash flow it, right? Like on new construction, because usually costs are pretty high. But that's kind of like what I build. But I build it in kind of workforce areas. It's a Class A product, mostly townhomes, like in secondary markets.
Yeah, I've seen
like
one
Savannah,
of those
Georgia.
projects.
Yeah.
Yep.
And so, dude, we build townhomes. They're about 1,000 to 1,100 square feet, 2-bed, 2-bath, vaulted ceilings. They got a little back patio. There's a pool, usually from the amenity standpoint, and we can build it for about $100 a foot.
Still now?
Yeah,
That's
well,
good.
we brought in in-house construction.
That's good.
So I had to hire somebody, put him on a 6-figure salary,
Yeah.
and he has 25 laborers.
It's worth it. Yeah.
All day, man. So now, you know, like early on, I had these big ambitions to vertically integrate everything. I wanted a brokerage, I wanted a construction division, I wanted a management division, I wanted, you know,
Yeah.
the private money and the mortgage and all this other stuff. And from a growth perspective, you realize those are all different businesses, really difficult to do.
And you still have to manage those people, and you have to manage the heads of those businesses, and it's a lot of overhead too.
Exactly. But
It's a
I've
lot.
gotten to and it's very hard to grow that, especially starting out. But I've gotten to a point now where I have enough infrastructure, team, and demand just in my own property. I don't need to get business from outside business in order to sustain all that, where I could just bring it all in-house. So we just brought management
That's good.
in-house, we brought construction in-house, and now there's less variables and just less question marks of things that can impact our bottom line.
I've been looking at construction as the next thing that I might bring in-house. I've been real hesitant because I almost like the GC model.
Yeah.
because it keeps my overhead low.
I love it.
Because I don't
Yeah.
have to scramble to do more deals in order to. But we're starting to hit some roadblocks where nothing from GCs is coming back at numbers that I like,
Yep.
and I know I can do it cheaper.
The numbers aren't there.
Yeah.
The timelines aren't there. You know, the quality typically isn't going to be as good.
And you're not their only focus.
Exactly.
That's the other part. That, from a management perspective, that is why from day one I grew an in-house property management company. For that reason, because I did not want my properties to be somebody's third or fourth priority.
Yep.
You know, my property
And it always
management
will be,
team
right.
only manages our portfolio. So from a construction standpoint, it's the same thing. You might have a great GC, but you're not their only client, you're not their only priority. They might have 5 project managers that work for them. You're probably not getting the best and the brightest in your job.
Especially because
Ask
you're
me
an
how I
investor,
know.
man. You got to go and I don't want to say beat them up on price, but you have to negotiate in order to make sure you get the best pricing in order to build this thing, in order to make sure the economics work.
Yeah.
And, you know, if you're not paying top dollar, they're not going to give you the top person to pay attention to
No.
it, you know, or
And
they're going to
everybody
pay
wants
attention
top
to a
dollar
job
now,
that has,
you know?
exactly.
Yeah.
They're going to pay attention to the job that has higher profit margin for them because that's where they're making their money. So
Yeah.
understanding just the human behavior and dynamics of that, they're going to follow, you know, the juiciest fruit, if you will.
Yeah, you definitely have more control by bringing it in-house. There's
Yeah.
no question.
Yeah.
So that might be the next area for me.
And when they're
you
not
know?
building something new, then they're out renovating a value-add apartment complex or building
Yeah.
something else
I mean,
for us. You know?
you need to be able to handle that overhead even when things slow down. That's the only problem. And I don't want to be in a position where all of a sudden now if things slow down, you know, Fed checks up the rates by 1.5. A lot of this development pipeline is going to fizzle out.
Yep.
You know, I don't want to be in a position where I'm laying people off. I want to
Yeah.
be able to put them to work on something else.
Yep.
So,
We have, I think the that's one of the benefits of building the bigger business, right? We're at a point where I think we can kind of self-sustain, and even if I had to put everybody as maintenance personnel
Right.
on different properties, I think I could do that and not have to lay anybody off and have higher quality maintenance people. You know,
that's good.
But we have a bunch of, you know what? We have a bunch of development stuff that's in the pipeline right now. Especially if they're willing to travel, we can keep them very busy. You know what one of our bottlenecks has been the financing
Really?
on construction. I mean, we can get, you know, debt funds and all that kind of stuff, but dude, just I find that I have, I think 5 development deals going on right now. Every single one of them is taken, I don't know, at least 6 months to close a construction loan.
Who are you financing with?
We've debt funds. We've done local banks on a couple of them. You know, national kind of still a debt fund, but more of a banking type of a lender. But dude, it just takes forever for some reason. And my team's on point, man. Like we're very organized on this stuff. And I mean, there's been a couple of loans that have taken 10 months to close. And we had all the approvals in place and all the zonings are there, and we didn't have to worry about any of that stuff. There weren't any title issues. It was just a very long process, but a lot of legalities and stuff. And then obviously the rates are going to be a little bit more because construction's seen as a more, you know, risky type of a loan. Who are you financing with? Local banks?
A lot of my stuff is with local banks. In Virginia, there's something called VHDA, but we were going to apply for our 130 unit project with them because it's 30-year non-recourse money even through construction,
Wow.
and it's cheap.
Is it a HUD product?
It's not a HUD product. HUD also has a product, but HUD
Yeah.
takes forever.
Dude, it's like 2 years.
HUD takes forever.
Yeah.
It takes at least 2 years. It's very cheap money. What a lot of people do is they finance construction with local banks and then get takeout financing from HUD.
Yeah.
Right? Or from Fannie Mae. But on the construction side, we were going to go with VHDA, but they have such a massive backlog that you can't even apply for 9 months. So now mostly I'm dealing with local banks. And there it's a question of who's willing to give you the best leverage.
Yeah.
You know, the attraction with an entity like VHDA is they're typically, because they're underwriting at like a 115 DCR
Yeah.
on a 30 or even a 35-year AM, your construction proceeds are this much. You go to a local bank and they're underwriting to a 130 DCR with a 25-year AM. All of a sudden you went from like a $22 million loan to a $17 million loan. Now that's $5 more million in equity that you got to bring to the table.
It's tough, man.
So then it becomes a game of let's go and talk to 5 or 6 of these banks. Let's figure out who's more aggressive.
Yep.
Who wants to gain market share in this area. And it's a constantly evolving landscape. But and this is what we tell our real estate students all the time, because people will come to me and they'll be like, yeah, I reached out to this local lender and this is what they told me, and I'm like, what did the second guy say?
Yeah.
And they're like, I didn't, I only talked to one. So go talk to all of them. Talk to every single one of them. But the point I'm making, we're still finding attractive terms from local banks, but it's a game of, let me continue talking to multiple and playing them off against each other a little bit, right?
You need to.
That's the only way.
Yep. We've had, I'm closing one with a debt fund actually this week on building out some apartments just south of here. And, the rate's higher, but they move pretty quickly, right? We'll close that loan in 45 to 60 days from start to finish.
On the construction side.
On the construction side, yeah.
That's good.
We already bought the land. We own that with just equity with cash from our investors. And then we're bringing, that lender. But that's been the fastest one. And it's still, they were hoping to get it done in 30 days, and it's been like 60.
That's good, right? Like, again, the 130 unit deal I'm financing, the appraisal alone took 2.5 months.
Yeah.
So I'm not, and
it's some of the third party that drags on.
So
there's a backlog and all that.
It's not fast, especially once you're dealing with commercial, because now they're waiting on the commercial appraiser. They want to do a land appraisal as is. They want to do an as-built appraisal, and it's taken them a long time.
So you obviously like the new construction stuff. How does that compare to? Do you still buy value add multifamily?
Not really.
No.
A number of reasons. One, I'm over doing rehabs. Like, I'm just over it. I'm done. Like, I cut my teeth on doing like historic gut renovations
those are the toughest. Right?
That's all I did from like 2009 to 2016. All I did was historic 100-plus-year-old properties, gut renovations, and
it's a good market for that though, right? In Richmond.
But it's a grind, and it's not a scalable way to build portfolio. I had only 3 things consistently in these properties. There was only 3 consistent things about them. It was mold, termite damage, and cost overruns. That's it. There was nothing else predictable about that business model whatsoever. You start opening up walls, and you're going to get termite damage.
The plumbing's wrecked. You got to expect it to redo everything.
You're gutting everything. But the other reason I'm not buying value add is because there's really no more opportunities to buy value add in my market that make financial sense whatsoever, right? Development is still an area where I can compete because fewer players, and right now I'm playing kind of in an interesting niche of the market where I'm doing deals that are too big for the little guy and too small for the big guy.
Yep, love that.
Right, so like I locked up a deal this morning for land where I'm going to build 40 units. This land was in the market. Everybody knew about it. Now I negotiated a lower price, but 40 units are too big for your average mom and pop rehabber, right? They're never going to do that deal. And 40 units is way too small for the guys building 100-plus unit deals with institutional money, who are all building within 2 blocks of this property. So it's an interesting niche because, there's a lot of players here, but there may be only a handful right here.
And the beauty is you still have, although it's only 40 units, you still have scale because you have other properties all in the area.
Correct.
So you can still lean on management, and you can have 150 doors all in the same vicinity with the same management right there. Yeah, so it's like the issue, not the issue, but like the hang up for a lot of investors is like, I need at least 70 units in order to have on-site management, on-site maintenance, on-site staff. You don't necessarily need to hit that number because you have enough in that vicinity, because everything you do is in Richmond, right?
It's all within a 5 to 7 minute drive from our property management office.
It's amazing.
It's literally all right there. And I like the smaller buildings, and we're building a number of them right now, right? 16 units, 25 units, 40 units, because they don't require on-site management, which also means we're not amenitizing them.
Right.
Right. I don't need to put a swimming pool there. I don't need to put a co-working space, a lounge. It's a building that's efficient in terms of leasable versus gross, right? You understand all this, right? These are buildings that are incredibly efficient in terms of leasable versus gross, and they're efficient to operate because I don't need to go and clean the pool. I don't need to go and do a ton of janitorial. I don't need to go and clean out my lounge and maintain the free coffee that you give to everybody, right?
What kind of amenities do you offer in your buildings? Do you offer some, like laundry, I'd assume, things that actually generate some revenue?
No. All our laundry is in unit.
Oh, okay.
The smaller buildings, we amenitize them via giving them good floor plans and their own outdoor space. Now, we also do outdoor courtyards. If I can add outdoor space on the property somewhere and give them like an easy to maintain common areas, then we do. But I'm not putting gyms in there. I'm not putting swimming pools in there. I'm not putting rooftop decks there.
They don't make money, man.
No.
Like, why? Yeah.
They're nice during leasing. It looks shiny. You walk people through and they say, oh man, this is amazing. Then they end up using that swimming pool once a year, right? So now I'm getting ready to build, again, like this summer we're gonna break ground on 130 units where I'm giving them a swimming pool, there's a gym, there's a lounge, and there's gonna be a 2,500 square foot dedicated co-working space specifically for the tenants. But in the project that size, I need to amenitize it. It's also a little bit of a remote location, so I need to make up for that lack of proximity with on-site amenities. But then we're going to build a 31-unit building across the street on land I already own, and there we're not going to monetize at all because they're going to
go across the street.
Exactly.
Love that.
So,
are there ways to monetize those other amenities? Like, do you charge monthly for the gym, or is it included in rent? Do you charge for like renting out one of the co-working spaces?
Yeah.
Or is that included, like first come first serve?
So I did the math, right? Let's say you have a 2,500 square foot co-working space, 130 apartments. If I charged $100 a month for that, what percentage of those units would probably subscribe? Maybe 10%, right? So I would make more money by making it free and just tacking on $30 to the rent.
Yeah, exactly.
And it doesn't even need to be a part of the conversation.
Yep.
So it's all included in the rent, but it allows me to charge a little bit more. And I mean, I'm honestly excited about that amenity because I think we're really going to tap into remote work, right? It's here to stay. We have a ton of tenants already that are not going to their office anymore, and they're not planning to go to their office. They're moving down from Northern Virginia to Richmond, still working in Northern Virginia. So it's going to be a cool amenity because I think it's going to actually get used quite a bit.
Yeah.
But if I start charging separately for it, it becomes a deterrent. I'd rather make it available to all of them, and it's just part of the rent.
I bet that's going to create a lot of community too.
I hope so.
It's like almost like your work environment. You go and see the same people working every single day and hanging out and kind of chumming it up and talking around the water cooler kind of a thing. And create some community. And all of a sudden, because people don't move from their friends typically,
no,
right?
It creates more retention.
Yeah, I think it would, for sure.
Of course. Yeah, I'm excited. I mean, I've got like interior designers designing the space, designing layouts. We're going to have a separate conference room in there. But it's also going to be like my on-site management office too. So it's going to serve two purposes.
Yeah.
So it's fun. Like I geek out on that kind of stuff.
Yeah.
It's a lot of work.
What are you doing? What do you think about the market? Where do you see the market for the next 12 months with potential interest rate hikes, with how heated it is on the multifamily side and how many people want in on it, with all the money that's on the sidelines, a lot of people who maybe shouldn't be active operators that are getting in to it and maybe fumbling the ball, or like what do you see the next 12 to 24 months in the market?
I mean,
based on your experience, I know nobody's got a crystal ball.
Real estate is market specific, of course, right? I think nationally, like transaction volume is going to go up. Like like you said, there's a ton of money hunting for deals, and a lot of owners right now see this as a good time to dispose of some assets at ridiculous cap rates and like ridiculous valuations. So I think transaction volume is gonna go up. Fed's gonna raise rates. They have to. They back themselves into a corner
for sure.
But they also can't. I truly don't think they can raise rates that much, right? So.
Not when we've been used to such low rates for, 12 years, 13 years.
They're in a tough spot because nationally we have a housing shortage. We need to produce more units. As soon as they start raising rates, the numbers are already so tight on the ground up development that an extra 50 basis points on my permanent financing might kill the deal, right? An extra point on my permanent financing might completely kill the deal. Or increase the amount of equity I now have to go out and raise. Now I don't raise equity, but if I'm a typical...
How do you do that?
My
your own
money.
cash?
Yeah.
So you're always bringing in your own cash for the 20% down?
Well, it's a different model, right? Normally, I'll buy the land with cash, and that's my equity into the deal. I have some larger projects where I actually finance a part of the land, and then we pay it down when we put construction loans in place. But I don't syndicate deals. I have a couple of buddies of mine that are 50-50 partners on select deals, but I'm not out there syndicating and raising outside capital, right? But if I'm a typical developer, rates go up by a point, I now have to go out and raise $8 million instead of $5 million in equity, and I'm diluting my cash and cash returns, my IRRs, to my equity investors.
Yeah.
So the point I'm making is, I don't think rates are going to go up a ton. I think you're going to see some posturing. You're going to see Fed raise rates a little bit. I don't think we're going to see a huge spike. The rental demand, again, I can't speak to every market, but the rental demand where we are is huge. We're bringing a record amount of units online as a city, and they're all getting absorbed. And so far, our vacancy rates are our occupancy rates are in the high 90s. I have to think at some point that music is going to stop and we're going to see an oversupply, but we've been saying that for 6-7 years. COVID happened, more people are moving in.
Yep.
So I think the rental market is going to stay strong. I think we're going to continue seeing some level of inflation. I think we're going to see continuous rent growth. Maybe not what we've seen in the last 12 months, but we're going to see continuous rent growth. And everything so far that we're bringing to the market is getting snatched up. I mean, we're leasing units when the drywall goes up, literally.
Love it.
People are walking through. My guys are in there hanging rock, and people are signing leases, putting deposits down because they want to live in a new construction product, and they need a place to live.
Yeah.
So I'm bullish in the market. At the same time, I'm watching my pipeline. I'm making sure I'm not overexposed. And number one goal for any developer or investor is not to blow up, right? So I'm making sure I have cash reserves. I'm making sure that my financing is structured correctly, where I don't have things expiring in the next 12 months. My existing portfolio, I'm refinancing everything. I'm refinancing anything that's due to reset.
Pulling
in the
out
next
as much as you can?
Not as much as I can.
Just at your cost or at the loan basis?
That's another dangerous move, is pulling out everything you can, because you're ruining your balance sheet, right? When I go to get more financing for more deals, every lender I talk to wants to see my global balance sheet, and if that thing is at 80% CLTV, it looks aggressive, right?
But what if you have? I mean, you're not going out and buying, rims for your car, right? Like if you're pulling out cash, it's going to be sitting in a cash account. You can say, hey, I got this much liquidity to offset that debt.
A lot of it is going to buy more land.
Right.
A lot of it is not sitting in cash for too long. I'm pulling out some cash right now. Don't get me wrong, but I have not stretched out the limits of what I can refi.
Right.
I'm constantly cognizant of my balance sheet, how my balance sheet looks. And again, if your global portfolio is at like a 1.25 DCR versus a 1.5 or 1.6, lenders are going to look at you differently. If I can go to a lender and I can say, here's my balance sheet, here's my portfolio, right? My CLTV is like 70%, and my entire portfolio, my global portfolio, my debt coverage is like 1.5, 1.6.
It's really good.
Okay, it's easy for me to get money.
Yeah.
It's easy for me to get money. Banks start fighting to give you money.
Yeah.
Because they always want to give money to who? To people that don't need it.
They don't need it.
So I'm definitely refinancing, but my biggest goal with refinancing is refinancing it to lower rates and pushing out my resets as far out as I can.
Terms. Dude, I mean,
as far out as I can.
I love that. I mean, that's something that I preach to my students too, is like, you want the longest term possible. I like long amortization schedules too. If you want to pay it down sooner, you can, right? There's nobody saying that you couldn't pay it off in 20 years. But I usually put a 30-year am on all my stuff because it allows me to make the minimum, like if things do happen, if COVID happens again or something else, you're not stuck covering this big nut every single month.
It gives you optionality.
Exactly.
Without a question. It gives you optionality. But what you don't want to be doing is, like, the month before your loan is about to reset or get called, you're scrambling to refi.
Yeah.
Right?
You don't want that.
That's the worst.
Yeah.
So
what are you looking for, like 7 to 10 years at least?
Everything I'm refining now is a minimum of 10-year reset.
Love it.
at least.
I do 10 to 15 typically, yeah.
I mean, I just refied a bunch of stuff into 30-year fixed paper in the threes.
With 30-year
30-year
term
fixed.
also? That's fantastic.
Yeah. Yeah.
Now, is that through an agency lender, like a Fannie Freddie?
No, it's through a non-bank lender that's basically brokering and selling that paper.
Okay.
And it's residential product. So my commercial
That makes
properties I'm
sense.
refinancing right now with local banks.
Yeah, because it really jumps
with
up
a
the
10-year
rate typically if you have a 30-year fully am commercial property.
Correct.
I found the sweet spot is that 10 to 12, maybe up to 15 years, and the rate doesn't jump up that much. It still stays pretty low, but that gives you enough freeway.
Well, if you're a commercial lender, like why would you lend in the threes fixed for 30 years? It makes no sense.
Yeah.
It makes no sense. But this is a loan product that they're selling off to investors that want to be in American residential single-family real estate.
Mm-hmm.
God bless you. You want to lend to me for 30 years
It's
at
a bond,
3.5%.
It's people who just don't want risk
great.
on their money.
Yeah.
It's predictable.
Yeah.
It's a low LTV.
Just clipping coupons.
Yeah, you're clipping coupons,
You're
right?
clipping coupons.
It's not going to go down in value, and you just keep on depositing your 3%. There's a lot of people like that, dude. My dad, if he gets a 6% return predictably, he'll be like,
thrilled.
I'd invest in. I put all my money into it, right? Because he's used to getting paid less than a 1% return on his certificates of deposit at the bank.
Yeah, yeah, we've all been just
So if somebody
beaten
gets a
down by
3%
these
pretty
rates.
predictably, I mean, hey, we think that everybody thinks like an investor. Hey, I wouldn't invest my money in something that only paid a 3% return, but that's because you know how to go out and multiply your money. Majority.
We say this about 10% returns, and normal people look at us like we have three heads.
Yeah.
They're like,
I'm getting screwed. Where's the
insane?
risk? How do I lose all my money?
Are you insane? Like if I could get 10% of my money on a regular basis,
Yeah.
I'd be all over it. So, yeah.
Which they should be, man, because it is to have a predictable return on investment of 10% per year, dude. That's and it doesn't have the volatility that the stock market has, and it's backed by a tangible asset, and it's got tax breaks potentially to it.
And that's the beauty of real estate, right? Like that's how we underwrite our new development deals. Are we leaving cash in the deals? Yeah, absolutely. These days you have to.
Yeah.
Some of my residential, like I build a lot of duplexes, and I can build them by residential building code, and the numbers in them even now are just stupid, right?
Yeah.
Like I just finished one last week where I'm into it for woodland 300 grand. It'll appraise for 440 right now.
Love it.
So I can pull out everything. But if I'm building by commercial code, I now went from like $110 a foot to $150, $160 a foot. I have to leave cash in that deal.
Yep.
Okay, I'm leaving cash in the deal. My cash. But if my stabilized first year cash and cash return can be 10%, fantastic. That's year one. On top of that, I'm immediately getting amortization. I'm getting depreciation. I'm getting NOI growth, appreciation. Not only that, but now I can accelerate that depreciation. You know all about that.
Yep.
And holy crap.
It's insane.
It's
Dude, people don't realize
it's unbelievable.
the benefits of being a real estate professional and having rental real estate in your portfolio.
It's incredible.
And the accelerated depreciation that what it can do to offset your earned active income.
It's mind-boggling.
It is.
And I only started doing it this year. I don't know how. And I consider myself a fairly educated and in the know person.
Yeah.
And I'm late to the game.
Yeah.
I just did my first set of cost segregation studies on a bunch of projects we brought to market last year. And I'm like, holy crap, why have I not been doing this sooner?
We just started doing it last year though too, so don't feel bad about yourself. Like it's just a lot of my stuff was value add components, and so we weren't sure if we were going to sell it, if we're going to hold it. Is it C class? Is it B class? If we refinance into something that we're going to hold long term, then absolutely we do that.
Correct.
If you're planning on flipping it, it doesn't make sense to do a cost seg.
Because they'll claw it back.
Yeah.
Almost
And then
immediately.
you're just paying extra money to do the cost seg, and
Yeah.
it makes no sense.
These
to
are
do it.
long-term assets.
Yeah, for sure. You got to. Then.
So I mean, the benefits of holding are just unbelievable. We used to look at 10% cash and cash return and go, like, low. If I can't get 15, 20%, now I'm happy with 10. Because that 10 in reality, after you add all the things that I just talked about, that 10 is really 16.
Absolutely, it is. Oh, and I love that you're not, you're not a hog, right? Pigs get fed, hogs get slaughtered, kind of a thing. And you know, dude, I have people all the time hitting me up saying, hey man, you know, if you could pay me a 24% return, hard money lenders, 24% return, I'm in. And I'm like, do you understand what the economy looks like right now? I don't need your money. Like, there's so much money looking for any yield.
Right.
There's no way that it, like, respectfully, dude, get your head on straight, man. It's just not realistic.
Cut that in 3 and we might have a conversation.
Yeah.
Yeah.
How about just go do good deals and have good relationships with the people you're doing business with when times are good? And guess what? When times are tougher to find money, I will pay you a higher interest rate because it makes sense then,
Still
right?
not 24%.
It's insane. Yeah.
I mean,
especially for somebody who knows what they're doing, right?
Right.
To go to somebody who has the experience that you have and say, I expect 24%. Dude, I've shoveled shit for 10 years in order to become an expert and the authority in my field where you have zero risk. Exactly.
How do I make money paying you 20? It's
And
ludicrous.
if you want to strangle the operator, then guess what? If you're not okay with the operator making money too, then why would they watch out for your money, right?
Yeah.
It's human nature, human behavior.
Yeah,
you got to let the operating partner make a bunch of money too, because that means it's the same thing, right? With when we're talking about contractors. Contractors are making more money on this retail job over here, so they're paying more attention to that versus your job. Same thing as a private money lender. If you're a private money lender, be okay hitting base hits. Base hits is what wins baseball games.
And that principle applies
and that way you
to
know
a lot
that
of things, right?
I'm paying attention, the operator's paying attention
You want
to your
the
money.
people that you do business with to be successful. Contractors are the same way. Like, we negotiate and we beat up contractors, but we know not to beat them up too much.
Yeah, not enough to cannibalize your deal.
If you're not making anything, I might win this time on this deal, but you're not going to be around next deal around to continue working for me.
Mm-hmm.
Like, we want people we do business with to be successful.
Agreed.
Right? So we get bids, we negotiate. I may beat people up here and there, but at the end of the day, like, if we're doing business together, I want you to win as well.
Mm-hmm.
It's not really a zero-sum game.
Yeah.
Now, yeah, if you make a little bit more money, maybe I make a little bit less. So sure, you can view that as a zero-sum game on this deal, right? But if you're available to me and I'm your first priority next time I have a job for you to do, right? And you saved me 3 weeks of my timeline next time, well, there's an added benefit to treating you well, right? Other than just doing the right freaking thing.
Right.
So it's all a relationship business. These are all relationships that if you maintain, the benefits are immeasurable, but so many people approach this business as if it's a one-time transaction.
Right.
You know?
I agree, man. They get transactional instead of long-term relationship-based, you know?
That's sad.
Yeah. So tell me about your, you have the info business, right?
Mm-hmm.
The coaching, the consulting business, and then you also have the software business. I want to know, are you spending a little bit more time on those things and growing that aspect because it's a little bit tougher to do some deals right now and you're trying to generate some more revenue over here as well? Or how are you balancing? Like, how much time do you spend on those versus your investment business?
I mean, again, I've got my hands full on the development side to the point where, like, that's all I should be doing.
Yeah.
You know, I need to hire people in that business. So no, I mean, I'm not having trouble sourcing deals. The software business originated at the same time as the real estate business.
Mm-hmm.
And it was really kind of an experiment. I had a job in finance. I worked in New York. 2008, I got laid off. I decided I'm not going to send out a single resume anymore. I'm done working, right? I owned a couple of rentals back home in my hometown in Richmond. So I moved back and I started rehabbing houses.
Oh my God, it's so
But I also decided to hedge my bets a little bit, right? I wanted to put something out there that will potentially also grow at the same time as my real estate business. And at the time, like, I don't know if the real estate thing is going to work out. So I said, what am I good at? Well, it's building financial models, right? So let me build. I had a spreadsheet built that I used for, like,
to make sure your numbers are dialed in.
Exactly.
Yeah.
So I started making that available to other investors. And slowly over time, it grew into like an actual software business. But I've stayed with it because it's helping a lot of people. You know, we've put out, we have a free version that we give away to people. We have a ton of content, ton of education that we give away to people as well. And, you know, over the years, it's helped out a ton of people.
Yeah.
So
No, dude. I mean, I love what you got going on that front. I think you need to keep on doing it because you're one of the good guys putting out really good content and at the same time doing what you preach, right? Practicing what you preach. There's a lot of people who just jump into the coaching business because reality is, man,
did like
it's
3 deals and now it's like,
it's-
oh, look
it's
at me.
right.
Like, yeah.
But it's not easy, dude, doing deals, right? Like, obviously, once you get to a certain point and you got the systems dialed in, the team dialed in, and everything else, there's efficiencies and stuff. But it's not easy growing that business, and especially when margins are really tight and stuff. So there's a lot of people jumping into that coaching business. So, dude, I got to give you a lot of credit for what you're doing and practicing what you preach and being one of the good guys in that space.
And caveat is we're really not a coaching company, right? We're a SaaS business. We put out content almost like as a supplementary resource for our software users. Because at the end of the day, we want people that use our software to be successful. And oftentimes, especially if they're new, giving them just a software tool alone, that's not enough. So we give them guidance, we give them education, we have like a very low dollar affordable group mentorship program, like an inner circle. We put out some courses out there. I'm getting ready to do something bigger on the real estate development side in terms of education that we'll probably launch in about 4 or 5 months. But they're synergistic businesses.
Love it.
And look, the other truth behind it is what I've built kind of works hand in hand because it allows me to not go out and raise capital. I have an operating business, a transactional business, right? Even software subscriptions, I view them as transactionals because people churn, people cancel. So I have a transactional business, an operating business that makes the money, and that money some of it gets reinvested back into software, but a lot of that money then gets invested into long-term assets.
Love it.
Then those long-term assets generate predictable recurring monthly income forever, and a crap load of depreciation that then wipes out all the income that the operating business makes. It's actually, from a tax perspective, it's incredibly synergistic. And it's also very helpful because, again, I'm not out there constantly raising equity.
Dude, I think it's one of those things that a lot of people don't talk about, but it is really important to have something that just generates cash and just kicks off cash and then deploy it all into income-producing assets.
And here's the other thing. Lenders love it. Lenders look at me differently because I have a completely independent business that generates consistent, predictable cash flow. Right? I'm not just a real estate operator. I have a completely separate business that I would argue is counter-cyclical, right? Because when there is a real estate recession, there's more buying opportunities. We're going to sell more software subscriptions. We're going to be able to help more people do deals. So there's a lot of benefits to, I'm serving 2 masters. And that's not easy, but there's a lot of benefits to it.
I love it, man.
So.
No, I love what you got going on, dude. And I don't know if you know this, but your podcast was maybe the first, or at least one of the first that I've ever been on.
Really?
It was 4 years ago this month.
Yeah. It's still on YouTube. It's still getting plays. Man.
Yes, awesome. No, that was one of the first ones. I remember in 2018, I think it was January 2018, I was down in Florida sitting on the back patio, and we were having a conversation. Man.
I remember you had sound difficulties where we couldn't hear a bunch of things you were saying, but
oh really?
Yeah, but it still came out good.
No, man, it's awesome. No, it's fun to see, guys that have been in the business for a little bit, kind of us coming up through the ranks together and seeing the success that you've had, seeing the success that Patrick Riddle's had, and Matt Andrews and all the other people who are here at this event that we're hanging out at today and tomorrow, and just seeing how everybody's grown,
and it's not overnight, right?
Dude,
everybody,
not overnight.
People look at you and they think man, the guy came out of nowhere. It's overnight, but we've seen each other's growth over the years, and we've seen the hard work that goes into it. And we know what it took.
And it's just good. It's good to see good people win. You know what I mean? And Patrick Riddle put together this event. He's just got amazing human beings because he's an amazing person, and he just attracts great people to his circle. So it's awesome to see everybody win. It's awesome to see us win together. And we just had Matt Andrews on. He's like, there's seeds that I planted 10 years ago, 15 years ago. He's amazing. And he's like, they're just now coming to fruition because he really understands the relationships.
And so, he's better than almost anybody at connecting those dots and
that's what he's made for.
And
that's why he was
creating
born,
connections
man, put on this
between
planet.
people, and it's that relational capital is something like he thrives at.
No, it's good.
Me, not so good. I can go like years without talking to people, but you know.
Well, dude, you're a hard driver though. Like you're an amazing operator and amazing at running things, you know, and getting your own hands dirty and stuff. You know, and like just kind of working at it like that side of things. And dude, I think you're consistently, you know, really understanding the relationships and starting to really connect with some people on multiple levels and doing some amazing stuff. So
well, I appreciate it.
I'm excited to do some stuff with you, man. I
Yeah,
appreciate
buddy.
you being here, brother.
Thank you.
Let's go hop on an elevator together and continue the conversation.
Let's never do that again. People still ask me about that.
Until next time, see you guys on Spill the Beans. That was an awesome chat with Daniil. This guy's got so much wisdom in the space and so much experience, especially in the new construction, new development side of things. If you're not connected with him, you need to be. Make sure that you know, check him out on Facebook, check him out on Instagram, follow him, and hit him up if you're ever in that Richmond, Virginia area. The dude is just a giver of givers. So great guy. I'd love to hear your biggest takeaway. Put it in the comment section below and hit the like button, hit the subscribe button if we're not already subscribed. And if you got value out of this, chances are somebody else will too. So please share this on your social media or send it over to somebody who you think could get some wins and some good takeaways from it. So until next time on Spill the Beans, go be your best.